Hello and welcome to Jazz After Dark, everybody. How you doing out there? This is a quick, well, usually quick, but kind of a laid-back show that we do. We're in no hurry. We're going to talk about some things here tonight. And to prove we're in no hurry, you grab a drink, you come hang out with us. This is Garrison Brothers, actually, a friend of mine, Tristan. Big fan of this. He lived back in Texas there, and he said, you got to try it. So I said, well, let's give it a try. All right. By the way, we're ranked the 66th best advisor in all of America. Did you know that? Jazz Wealth? You want to check us out? Hope you'll grab a drink and hang out with me. Okay. All right. That's pretty strong. All right. Very oaky, right? A lot of wood flavors inside of there. Not as sweet as I would like, but that is a manly bourbon right there. Hey, by the way, that thing, if you look up USA Today best ranked advisors, and you find that we're number 66, there's like tens of thousands of advisors out there. So we're happy with 66. You know how that works? They let you know ahead of time that you're going to be on the list. I'm not trying to discount this at all. I'm happy. But they let you know ahead of time you're going to be on the list. And then they offer to sell you stuff. So if you ever see an advisor that's like, oh, we're ranked number 100 or whatever, and they show the logo, they paid for that. Right? It's kind of cool. You could buy all kinds of different things, and we're like, but you told us we're going to be on the list. Why would I buy something from you? I'm already on the list. So we just can't use their logo. But, things like that happen. So anyways, we're going to talk about what everybody's calling the Rothification movement, right? I don't know if you know this, but so the Secure Act 2.0 put in place a change in the tax code. So you may notice like your tax brackets are a little bit lower. Well, that ends at the end of 2025. So you should expect that through the year 2025, there's going to be a lot of discussions wrapped around what we're going to do with the tax brackets. Now, there's going to be a lot of discussion around how much it costs the government to continue having the taxes the way they are. If Trump, now the president or president-elect, were to want to continue that. Fun fact, there's something called scoring. So you ever see when the government says, we're going to cut taxes here or make this adjustment, and it's going to cost the government $1 trillion, which is actually what it is projected to cost with these current tax cuts. Well, they call it scoring because they actually only look out 10 years. And that's a score, right? So they say, we only really care about the 10 years. Well, when it comes to like retirement accounts, if you're 40 years old, what it costs the government for you to put money in a Roth now may not cost them until 25 years from now. Well, that's not factored in. So they call it scoring. It's only looking out 10 years. And you'll notice that whenever, and especially since Trump now is going to probably have a lot of changes, they're going to talk about how much it costs the government over 10 years. They don't look any further than that. I think that's a mistake. Anyways, a common argument that I get is, Dustin, I'm 45 years old. I don't care if I make a lot of money now. Why wouldn't I just forego the tax now, pay the tax now, and let the Roth grow? If it grows, let's say 7% a year, really it's 10% after inflation, we say 7%. But if it grows that much, then I'm 25 years down the road, and I know I will have recouped the taxes and some more growth. So why don't I just do that? It's not a bad argument, but here's the little mistake people make. This is a big one. When you contribute to your 401k, let's say, for example, you are married filing jointly, and I'm going to make it easy. You make, let's say that that's the case. When you contribute to your 401k, you're reducing your marginal tax rate, like the limit, the right where you cross it. We have a progressive tax system here, right? So some of your dollars get paid at 10%, some of them get paid at 12, some of them 22, and if you get going further than that, 24, and so on. So you make $95,000. Well, your marginal tax rate is what's affected here. So meaning if you were to contribute $5,000 throughout the year, you would actually bring yourself back into the 12% tax bracket. Okay, so it's kind of a huge savings. Now, if you contribute to a Roth only, right, and you make 95 in that year, you will have paid 22% on the contribution, right? Because you owe tax on that money. You're contributing at your marginal tax rate. But let's think about this. you don't actually pay 22%, do you? Right? Like if you make 95,000, you didn't pay 22% in taxes. Maybe you paid somewhere between 11 and 15%, depending on if you were lucky enough to, you somewhere in there. So think about that. We contribute to the Roth IRA, right? And we're paying essentially the 22% in tax. But when we get to retirement, the money that we would have paid on an IRA contribution is our effective tax rate, your blended tax rate. So it's wrong for people to say, I'm in the 22% tax bracket. If my account grows by more than 22%, then I would have broken even and potentially been more beneficial to contribute to the Roth, right? Not really, right? Because the money that you would have taken out of an IRA would have only been taxed at your effective tax rate, your blended tax rate. You are not taxed on your IRA income at your marginal bracket, right? And most of us live on lower income in retirement. So this is a good thing, by the way. So if you're trying to calculate the difference, and we do this for all our clients, we try to tell them, right? Like, and actually, we're working on something we call Project X here, just a little side topic. What if an advisor could know everything about you, could see every single piece of your life and help you make decisions on that? That was my vision from day one here at Jazz Wealth was, I don't want to just talk about retirement all the time. I want to stop the person from going on a cruise if they can't handle the cruise. I want to help them by determining that they should put 21% down on their house because they have the dollars to do that and they won't affect their emergency fund. They won't hurt their retirement. Right? I want to see everything. And so coming up, we're working on it right now. That's why I haven't been around as much. Anyways, vision of mine for years. I've been dying to do it. So anyways, you can't say, well, I'm at 22% bracket. Therefore, if I can grow more than 22%, then it would have been better. No, that's not the case at all. If you would put money in an IRA and you're saving on the 22% tax bracket, your effective rate in the future, your blended rate would actually be lower than that. So it's a good thing because you don't need as much growth. And if you are 40 and you make $200,000 a year, yeah, you probably are still better off using the Roth because you're 40, let's say in this case, right? So, right? It's not like I was trying to make a big point here today. I was trying to show you that it's actually easier to consider the Roth versus the IRA or your 401k or whatever. This could be your Roth 401k, Roth TSP, et cetera. It doesn't have to be just an IRA. Now, could the government find out that, hey, we need to raise money and the tax brackets, let's say they budge a little bit. They go from 22 to 25 and as they're supposed to, right? They could find that they get money elsewhere, which would lessen the impact of all, as like a balance sheet approach, would lessen the impact of the dollars you put into the Roth. That's a guess. I don't know. We can't operate today as if we're guessing what the future holds. I would bet that most of you feel that taxes as a whole will be higher in the future than lower. All right, if that's the case, then we want to nick the things that we can, our Roth 401k, Roth IRA. We want to get those things in a tax-free position as much as possible. Roth SEP IRA is coming out here soon. So the point of today's short video was to say, remember the difference between your marginal tax bracket and your effective tax bracket. This is a conversation we have with clients all the time because I go, you're better off putting money into a Roth. And they go, well, I'm married filing jointly and I make $350,000 a year. How are you coming up with this number? Well, it's the difference between what you pay now, the future growth, and then what you would have paid in retirement if you'd have used a 401k or an IRA. Add to that, there's the other benefits of not having the RMDs and not having to deal with taxes when you're maybe passing some of this on to beneficiaries and such. It may mean more to you, right? So don't give up on the Roth. And I would argue that a lot of the younger crowd, I don't care what your income is. I mean, if you're making $5 million a year, okay, we're playing different strategies with you anyways. There's like a whole big picture thing. But if you consider yourself a high income earner and you have like 8+ years until retirement, I'll bet you we could find a way where we go, it still makes sense for you to put money in the Roth because of the difference between your current marginal rate and what your effective rate will be in the future if you chose to use an IRA, right? Does that make sense? Am I getting somewhere with this? I'm not sure I like this, by the way. This is, it's not bad. It's not bad. I prefer a little bit more of the spice and the sweet in bourbon. Buffalo Trace is obviously my favorite. This is not bad, but this is it's an obvious Texas bourbon. Like you just go, okay, that's a manly, like thick feeling to it. Anyways, thank you for paying attention here for a little bit. I'll wrap it up there. We'll be back with more videos here this week. We've got a lot to cover, actually. So I hope you hit the subscribe button. Check us out at jazzwealth.com. And if you need an advisor that in the very short future will be able to see your entire life, how to help with anything, that's about to be us. And no, we're not getting some software that like we could just buy from some. No, we're making it. We're building our own software to track your entire life, and it's going along